any specific questions for me? Something you want me to share my thought on? You can raise your hand, I'll bring you up, or you put it in the chat for me. Give me a moment to let me see if our YouTube stream is live. I don't know. Our YouTube stream is not live yet. Whatever, it's supposed to be live any moment soon. Hey, fear. Give me a moment. Just want to see if right, so our YouTube is live as well. Okay, so good evening to everybody, and happy mid-year to everyone as well. Today is the last day. Today is the last day of the mid-year, so tomorrow is July, and we are starting the second half of the year, and you are writing your exams tomorrow. Okay, so before I get excited, I'm gonna get excited and talk a little bit, but before I get excited, if there are any specific questions, all right, we are not teaching. You know that already. So specific question, something that will not require me to talk plenty, sweet, simple, straight to the point, something specific you want me to share my thought on, you can raise your hand, I'll bring you up. Those of you are joining me on YouTube, on the Zoom call, or better still, you put it in the chat for me. If you feel your background is too noisy and you can't talk, then you put it in the chat. Those of you joining us online, Facebook and YouTube, you can also put it in the chat. I'll be referring to your comments as well and bringing them on the screen as we go. Yes, Candy, what you got?
Good evening.
Good evening.
I want to ask a question on consolidated cash flow.
Okay, shoot.
So, would there be a question where there will be the sub for us to do the cash flow statement?
No,
like we have the subsidiary and the sub.
It doesn't matter, because when we are doing consolidated cash flow, what it means is that you are going to be given consolidated financial statement. So you're going to have consolidated P&L, consolidated position. So what it means is that probably during the year, the entity may have done some acquisitions. And even if they do any acquisitions during the year, the cash they pay to that entity will come to the investing activity, as you know already. And then you will calculate goodwill on acquisition, so that you can now bring that to the goodwill account to calculate any impairment in goodwill. So in cash flow, there is no problem there, because you are given the consolidated P&L, consolidated position. If there are any acquisitions during the year, then in your working capital workflow, as you remember the workings, you bring in the opening balance, then you have to bring in the working capital of the subsidiary that was acquired during the year. So if during the year the parent entity acquired and then the subsidiary also made an acquisition and we have to consolidate, then the current assets of the subsidiary and the sub-subsidiary will be adjusted for when we are working for the working capital. So it doesn't change anything. We still apply the same concept that you know, because we are working from the consolidation environment already. Does that make sense?
Okay. Thank
you. Okay. Yes, Christina, your hand is up.
Good evening, sir.
Yeah, good evening.
Sir, please, can you throw more light on the asset ceiling and the defined benefits?
Hey, don't go there. That's not in your pay grade, please. Forget about it. It's not in your syllabus, so forget about it. It means you are solving a question that is coming in from 2003, something like that. Please, that's no longer in the standard. So stop looking at it. I think Nathan also asked about this during the class, and I mentioned the same thing. So please don't look at it. It's not.
Okay.
Just
So please
focus.
there.
Just focus on the basic issues. I mean the normal calculation we know. Then when there is transfer, the way we do the gain or loss on the transfer and how that goes to the
Okay.
P&L accounts. That's all you have to do.
Thank you. So
Right.
please, the second one is on the value. Is it value added statements?
The concept of value added statement, it's actually not the statement. It's just an auxiliary statement that is prepared. The idea about the value added is simply where we want to look at the value that has been created during the year and how that can be distributed to the key stakeholders of the entity. So this is the idea. To do value added, we identify the key stakeholders of the entity. So who are the key stakeholders of the entity? The employees and management, the providers of finance, government, and then, these will be the three top. So the way the value added statement works is that you bring in your sales and then you're going to subtract your bought in material, like materials that we bought, auditors that we hired during the year to audit the financial statement, and then any other operating expenses that we paid, those will be subtracted from the sale. Then we get the value added. Then that value added figure will now be shared. How much will go to employees as wages and salaries and wages? How much will go to the government in the form of taxes? How much will go to the providers of finance in the form of dividend? So that's all about the concept of value added. Let me see if I can have a slide to just show you this one. I don't know if I have my slide pop up or like that, because I'm not sure I wanted to. Okay, so I think I have a slide. Let me see if I can bring that. But when do we say an asset is impaired? An asset is impaired when the recoverable amount is less than the carrying amount, or flip side, where the carrying value is greater than the recoverable amount. So the question we ask ourselves is, how do we determine the recoverable amount of an asset? And that is where two measurement basis concept comes in. The value in use, that's a measurement basis, and then the net realizable value, another measurement basis. And so we say the value in use is simply the present value of the future cash flows from the continuous usage of the asset. And so we are going to be discounting these cash flows using the pre-tax cost of capital of the entity to get a value in use. But it is important you understand that when we talk about the cash flows from the continuous usage of the asset, it is usually going to be made up of two things. We are talking about the annual cash flows we will receive, plus if the asset has a scrap value at the end of the economic useful life, that will also be included in measuring the value in use. But the key thing here is this: we are discounting the future cash flows using the pre-tax cost of capital of the entity. Or we then go to the net realizable value. This is the amount we will get today if we decide to sell the assets now. And so that is going to be the fair value minus the cost to sell. Remember, the cost to sell will have to do with issues such as commissions that we are paying to the sales agents. And so we subtract that from the fair value or the selling price, boom, we get the net realizable value. We compare these two. If we have them in the question, we compare the value in use to the net realizable value. The higher of the two gives us the recoverable amount of the asset or the recoverable amount of the cash generating unit. We now compare the recoverable amount to the carrying amount. And if the carrying amount, the amount at which we are carrying the item, the asset in our books, or the cash generating unit in our books, exceeds the recoverable amount we got, boom, the difference becomes an impairment. The difference becomes an impairment. And it depends. If it is a single asset that has suffered an impairment, that is going to be treated as an expenses in the P&L account, because all we do is to debit P&L and credit the asset. It ends there. But if we are dealing with a cash generating unit, then the impairment loss would have to be allocated in a certain order as per IAS 36, impairment of assets. And so if you remember, the guiding rule is that we're going to take out separately identified impaired assets. Because it's a cash generating unit, if there are specific assets in the pool or in the cash generating unit that were specifically stated in the question to have suffered an impairment, boom, we write them off. Second, if there is goodwill, because we are dealing with a cash generating unit, boom, we write it off. Any amounts that will be left will now be shared on a pro rata basis using the carrying amount of the remaining assets. Note that issues such as trade receivables, trade payables, cash really don't suffer impairment, and so we are going to be allocating the impairment in that order. But there is one principle you don't want to forget, and we discussed this in class, that after allocating the impairment, an asset must not be carried below its fair value less cost to sell. Let me take that again. After allocating the impairment, an asset must not be carried below its fair value less cost to sell. So if it is a cash generating unit and you have finished the allocation, it is important to come and look at the fair value less cost to sell of them. If any figure after the allocation is less than the fair value less cost to sell of that particular item, then you have to bring in the fair value less cost to sell value so that the difference in the excess will be allocated to the other assets. And this is an important principle that you must understand when it comes to impairment. But that is the concept about the measurement basis. You are seeing it working through in the discussion. Then you come to the idea about IAS 38, because once you're talking about issues in respect of measurement basis, it's going to be spanning across also in IAS 38 intangible assets. Keenly, there are 3 things you want to take away, maybe 4, or I could get goosebumps and do it 5, maybe 5 things. Number 1 is all research expenses will be written off as incurred. Number 2 is going to be the fact that, still on research, right? Capital expenditure incurred on research will be capitalized and depreciated over the economic useful life of the asset. So that is research done. Development cost. The standard says that development cost should be capitalized if the recognition criteria is met, and that is the sector recognition criteria. It should be separately identified project. The cost should be reliably estimated. There should be a commercial value there. Then there is technically feasible. Then there is overall profitability, and the entity has resource to complete it. But if you remember, we mentioned that really in the exam hall, or when we are given a question, the cost will reliably be estimated. So that one, we will see the figure. But what will really trigger us to determine whether we should write it off? Because remember, if none of the criteria is met, then certainly what is going to happen is that although it's a development cost, we have to write it off in the P&L account. So the trigger for us, based on the context of the question, will be the issue about commercial value, whether there will be market for it, or whether there will be issue in respect of technical feasibility, like we can do it, or whether we will have resource to actually complete it. So one of these guys will be present to help us to conclude whether we should capitalize or we should write it off. If we cannot see, apart from the cost that they have given us, other factors, please, although we've had development cost, it will be written off in the financial statement for the year. Remember, capitalized development cost cannot be revalued upward. Let me take that again. So we may read a question, we are going to be told, we will be told that, or we may be told that, hey, management has gotten excited and they said, oh, the development cost capitalized at the beginning of the year, at the end of the year, government has made a certain announcement, and so now the development cost has increased in fair value. We don't fair value measure or revalue development cost, but we test for impairment. So the value cannot go up because you are capitalizing a cost you have incurred. How the heck do you now say you incur a cost of 10,000, But because of a certain thing, that 10,000 is now 20,000. You see, that is delusional, right? So that is why upward, that kind of thing is not allowable under the under development cost. But it could be tested for an impairment. So if, for instance, something has happened which it's putting the development of the project into doubt, or which they are not really sure whether they can move or not, we could test for impairment. And if there is any impairment loss, certainly it must be written down and recognized in the profit or loss account as well. So that is the second thing, development cost. Then certainly the last one, which you're going to be needing in consolidated financial statement IFRS 3, is going to be goodwill. Yes, goodwill arising from business combination can be recognized in the separate financial statement of the investor, or if you want, the parent entity. Then on the consolidated financial statement, we bring goodwill also there. But internally generated goodwill cannot be recognized in the financial statement. So an entity cannot just get up and say, oh, depending on how excited we are, if we look at our market value, look at our net assets, we feel that our goodwill is whatever the heck, and so they want to recognize something. That is forbidden by IAS 38, intangible asset, and we cannot recognize it. So these are the three key things that we must understand under IAS 38. Another thing we need to understand is the initial measurement, which is the same as IAS 16, IAS 40, IAS 38 is the same thing, because the initial cost of an asset shall be the purchases cost plus all other directly attributable costs incurred in bringing the assets to its present use. That rule is in IAS 16. That rule is in IAS 40. That rule is in IAS 2, inventories. That rule is in IAS 38, intangible assets. So it's the same thing. It is the same thing. Now, the key thing that we need to understand is on the subsequent measurement of intangible assets is depending on whether they have a definite economic useful life or indefinite economic useful life. If you remember, we said intangible assets with definite economic useful life, meaning that there's a number of years that they are going to be used. They have to be amortized over the economic useful life of the intangible assets, and any amortization will be recognized in the P&L account. But intangible assets with indefinite economic useful life, if you remember, we said, boom, it should not be amortized because there is nothing to amortize on, but rather we test for impairments once a year, and any impairment loss will be recognized as an expenses in the P&L account. So that is also the idea about intangible assets and what we need to understand. So treatment of research, treatments of development costs, how we deal with issues about subsequent measurement, very important. You need to understand these things very well. So really the measurement basis is scanning through the syllabus. Let's even get excited to corporate reporting students exclusive and talk about the issue in respect of IFRS 2 share-based payments. If you remember, when it comes to share-based payments, share options, share appreciation right, we need to use the fair value of the option or fair value of the share appreciation right. And so it is important we understand how the fair value of the option or the fair value of the appreciation right was determined, because sometimes an entity may give a share option or a share appreciation right, but the entity's share is not listed on the stock exchange. In that case, how do we determine the fair value of the share option or the share appreciation right? We then have to go back to IFRS 13 fair value measurement and go through the hierarchy. Now, level 1 is not there because it's not listed. The company is not listed. So probably level 2 and level 3 could be an indicator for us to measure the fair value of the share options or share appreciation right. So what am I trying to say? What I'm saying is that the measurement basis, yes, technically you may not have a question about it, but it is actually working throughout the entire discussion that we are going to be having, dealing with various accounting standards that you need to talk about. So the historical cost, the fair value, the net realizable value, the value in use, and then certainly the current cost, or if you want, the replacement cost. Now, the current cost generally is like an umbrella name, which will include the fair value, because the fair value can also be deemed as the current value of the asset or the liability in question that we are looking at. So measurement basis, crucial. You want to make sure that you really understand them very well, and the way they are creeping naturally in the various accounting standards, and it should be good in that case. So you see the way we treated it, and then I've walked you through a number of the accounting standards and the applicability of the measurement basis. The reason I did what I did is because, as I told you, the examiner may ask you a standard question. Now, I don't know which accounting standard the examiner is going to hit your head with, but there's a 5-mark question also on an accounting standard, and it could be anything at all. All right? Anything at all. So conceptual framework, boom. An accounting standard theory. I don't know what the heck the examiner will be excited to ask you, but he's going to be asking you something about that. Then we may have consolidated theories in the exam hall. On what? On consolidation, everything. Like, how can an entity gain control? Like, what is the difference between significant influence and control? Like, how do you treat negative goodwill? Like, why will goodwill even be negative? Like, what should an entity do when the goodwill is negative? Like, what are the indicators of significant influence? Like, how do we treat intragroup sales? Like, how do we treat intragroup transfer of assets? Like, anything in the consolidation, the examiner can ask you about it. So it may be theory on consolidation. You want to make sure that you know them pretty well in that case. And if you have watched the summary videos in the mobile application, I covered all of those things in the summary video, which I hope you have watched now, because if you have not, I don't know what the heck you've been doing though, but you should be able to watch those summary videos. Then we come to ethics. We are about 99% assured there will be an ethics question for corporate reporting students. 99% assured. But financial reporting student, the examiner may not get goosebumps for you, because there are certain examination that is like, oh, I got a lot of things to ask you guys, which is true, right? So ethics, we are not sure for financial reporting students. Nonetheless, we discussed it. You must know about it. Technically, it's about knowing how to read the question and then knowing how to bring out your things. But you want to also understand that ethics question can come from other angles. So what you may be familiar with is the scenario-based ethics question, where you read a question, oh, whatever the heck, Adepa is the accountant of the firm, and Adepa is liked by the CFO of the company, and by their relationship, Adepa, the CFO told her the 4th style of ratio question available that the examiner can take you to. And that is the bare minimum, if you want, for the financial reporting students. But if the examiner gets goosebumps, then he will ask you for common size analysis, corporate reporting students, or the cash flow analysis as well. So these are the options available to the examiner. Remember, know how to pick your data about the calculation, because some of you, the calculation see, if you get a calculation wrong, the analysis is wrong. Forget it. I've had people who are like, oh, Nhyira, yeah, I know the calculation is wrong, man, but just read the analysis. There be, bruh, we don't do it like that. Sister Ama, the calculation is wrong. What analysis did you write? It's also wrong. So please, we don't know which style of ratio questions, but I hope that you have exposed yourself to all of these style of evaluation questions. But the interpretation is the interpretation. Keep your pro forma, have your intro, Make sure your intro is sweet, simple, straight to the point. No long talk, no unnecessary things. Hit it in the head. What the heck is this about? What is the basis of comparison? What is the year ended? What ratios are you using? Please put whatever ratios you are using in their category. Profitability, liquidity, gearing, investors ratio. It's not now you are going to say, oh, this is the analysis of the financial performance and financial position of Nkunku Limited for the year ended, whatever the heck, using net profit margin, operating profit. Debbie. Don't go and do it in the exam hall. Put the ratios in their category like that in your intro. Right after your intro, now take the category like that as a paragraph and do the explanation. Remember the principles about the explanation and the interconnectedness of the ratios. Right? You know that. We've explained this. And so if you're doing profitability ratios, you want to talk about revenue. Is revenue rising or falling? Net asset turnover. Okay, then you want to talk about cost of sales. All right, gross profit margin. Then you want to talk about operating expenses, net profit margin or operating profit margin. Then you want to talk about ROSI, which means you're going to refer to rev, gross profit, net profit margin, and then changes or movement in capital employed. Please be mindful of this. Remember again, we don't know what the heck the examiner is going to bring, but remember when you're explaining the working capital ratios, for instance, inventory, there are two ratios that can be used to calculate the efficiency or to assess the efficiency of the inventory management system of the entity. Either we are using the inventory turnover or the inventory turnover period or the inventory holding days. Only one of these can be used to tell us about the efficiency of the inventory management system of the entity. What the heck do we mean? If it is inventory turnover, that is assessing how quickly the entity sells its inventory. And so that is the cost of sales divided by your average inventory. And the answer will be in times. And we want this figure to be higher. We want this figure to be rising. If it is higher, it is rising, it is greater, it means that the entity sells its inventory quickly and hence they may have efficient inventory management system in place. So they don't keep a lot of inventories in stock, which means they don't incur a lot of storage costs. They wouldn't suffer obsolescence. They wouldn't suffer inventory, how do we call it? Thefts, inventory thefts. But if we are going to inventory turnover period or the inventory holding days, please, the examiner can trap you. So you got to be careful. You can hear inventory turnover, but there is period at the end, which means you are working in days. And that is going to be your closing inventory or your average inventory divided by the cost of sales times 365. That will be in days. And here we want it to be lower, reducing, or less. If it is lower, reducing, or less, it means that the entity is keeping inventories within a short period of time before they are sold, which means they may have an efficient inventory management system in place. So the two are all looking at the same thing. Will be there. 2 or 3 of them will be there. There will be a question and you should be able to answer them. Then the 3 wise men, you have to know about them because the examiner may call on you to apply them. Then for corporate reporting students, your exclusives, you need to pay attention to that. But as I said, your exclusive can be in the consolidated financial statement, just like the question we solved in class, where, people were like, oh, Nhyira, I have learned IFRS 2 and IAS 18, but it's not in the question. You remember I said, go and answer the consolidation question because sometimes that could be buried in the consolidation that you need to understand. So the accounting standards, IAS 2, IAS 8, what I would just tell you is, yes, know that the non-current asset standards, there will be question there. You cannot run away from that. know the 3 wise men, 15, 16, 9, and everything there in that regard. Know the exclusives for level 3 students very well. And then certainly the other guys, IAS 2, IAS 8, IAS 10, IAS 33, and in special, those other guys. So you got to know everything. And that is why definitely the summary videos in the mobile application will be helpful, so that all you're doing is taking the principles, because in the exam hall, you're just applying principles generally. And that is the accounting standards. So theory, evaluation of financial statements, then the accounting standards. For financial reporting students, you know it is 45 marks. 45. 20 on dedicated accounting standard, that is question 2. 20 on the single entity financial statement, because in the single entity financial statement, almost all the footnotes are accounting standards, making 40. And then if the examiner gets goosebumps, you get a 5 marks theory question asked by the examiner. So 45, done deal, just on the accounting standards. And you can pass the exam or fail the exam based on your understanding of the accounting standards. For corporate reporting students, we know give and take 30 to 40% in the exam hall. Question 2, 20 marks on accounting standards. Question 3A, maybe 10 mark question on another accounting standards, making 30. Or sometimes 27. Then there will be accounting standard question that the examiner can ask you, making 35. So dedicatively, if I can say that, we're going to have 35, 40-ish specific on the accounting standards corporate reporting students directly. And you want to make sure that you understand this very well. But if you remember, this is for corporate reporting students. We're going to have financial reconstruction, corporate reorganization, or business valuation. One of these guys will be there. And so you want to, again, remind yourself on the principles of all of the valuation methods. And we have added the summary videos of all of these things. I think some of them are 15 minutes, 9 minutes, whatever the heck minutes. You want to get the principles. Net asset method, earnings yield method, PE ratio, whatever the heck, earnings yield method, cash flow method, know the principles underlining them, dividend valuation method, know the principles underlining them. Then we come to our guy, financial reconstruction, corporate reorganization. Boom. You need to understand the principles there. Again, we have the summary videos in the mobile application that will help you on the principles, because remember, that's all you need. That is all you need, because in the exam hall, and I'll come to that in a moment, you're just going to be applying the principles. So these are the things that we are going to be seeing: theory, ratios, standards, then corporate reporting students, business valuation or financial reconstruction, one of them present. Then the last thing is going to be, the lion in the room, question 1. Consolidated financial statements. As I have recommended, I think this should be your last but one question. That's my recommendation. It should be your last but one question. And all you're doing is to take some easy marks on the goodwill, on the the various workings. And it's not about, hey, I want to extract the financial statements. No, you are just about reading the notes, interpret. You're reading the notes, working. That is question 1. But on the general level, you must understand how to get your group structure. That's simple. You must understand how to get your consideration transferred. You must understand whether I need to prepare net assets or not, depending on the context of the question. But always endeavor to calculate the goodwill, because the examiner is going to have some 2, 3 marks or 5 mark question allocated to the goodwill at acquisition. And so it's important, or goodwill at the reporting date, it's important you calculate your goodwill. Remember, if goodwill is negative, that means it is a gain on acquisition. And so if goodwill is negative, it's a gain on acquisition. If we are preparing consolidated P&L, that will come as a line item in the consolidated P&L. If we are preparing consolidated statement of financial position, that will be brought in as an amount that will be put on the group retained earnings to get the net values coming in that particular case. If we are preparing consolidated cash flow, nothing will come in the goodwill calculation, so we can get impairment in goodwill. So you must know how items are treated depending on wherever you are at. That's it. That's it. And then know how to deal with fair value adjustment. It's going to be there. So you got to know. Remember, you read and accuracy. Speed and accuracy. Some of you, I've told you this. You're too slow. Your handwriting sucks. I don't know how you're going to deal with that. But you got 3 hours. So find a way to manage your time. That is why I said, especially if you're able to take out the theory parts, like you're able to take some time from that, because you don't need a lot of miracles on ethics. You don't need a lot of miracles on a standard theory that has come if you are strong in the standards. You don't need a lot of miracles on a consolidation theory that has come if you have learnt all the theories in consolidation. So you could save some coins time there, get enough marks. So if you look at the proportion of time you spend and the marks you are likely to get from the theory, it's a good trade. So you take that out, then now the other questions, you look at what can I do? Where can I take some marks? Where can I take some marks? That's all you are doing. Speed, accuracy is important. Nobody cares about your slowness. We don't care. And you know nobody cares. So you better raise your game and punch the things as fast as possible. And make sure you have a good calculator with you. Okay. Seeing some comments coming up. Let's see if I can take some comments real quick and then what the heck. Let's see. What do I have here? What do I have here? Ndongi, how can I get your books in South Africa? Order on Amazon. Go on Amazon, search for My Name is Nhyira Premium. The books are on Amazon, so you order on Amazon and they will arrange delivery for you to get it. Okay? So you can order the books on Amazon. Search for My Name is Nhyira Premium on Amazon and then you'll be able to get and order the books there. What about the price of ACCA? Our ACCA lectures are on private basis. Like if you want to have an ACCA lecture with me, we don't have a regular class. It's on private basis. And that starts at 5,000 Ghana cedis for 12 sessions and some few things. So you can send a message on WhatsApp, the number on your screen. And if the 5,000 cedis is a fair or something that you can afford, then we can talk about time. But if you want to have an ACCA lecture with me, it's on private basis and it starts at 5,000 cedis. So if that is okay for you, you can contact us. If it is not okay for you, you can look elsewhere for a class on ACCA because we don't have a regular class for ACCA. What else do I have? Oh, I think that's all. Okay, that's all. I'm done. Okay, so I think I'm done, right? So you can go and chill and do whatever the heck you want to do before tomorrow. So please, as I said, at the end of the day, know the various options available for the examiner. These are the notes you want to tight from now till tomorrow morning for FR students, tomorrow afternoon for CR students. All right, that's it. But please take your time in the exam hall to read the questions. Just take your time. Read as you work. Read as you work. Take your time. I promise you, you're going to be good. If really you are strong and if really you understand what we have done, you should be good. Okay? You should be good. So that's it about that. If there are no other questions, then we will wish you all the best. in your examination, and you go in there, make yourself proud, and do well. Please make sure you have a good night's sleep. Okay? Sleep well tonight. Sleep well. Tomorrow morning, get up, have a great breakfast, right? And as I said, chauffeur to the exam hall, get there early. And then when you get there, you are just cruising. Okay? You're just going through some few things, tiring some notes here and there, watching some of the summary videos if you have to watch. Just slow, like tiring. This time around is cruising. No pressure. You're just cruising. And let the exam comes. You will be able to take out your theories, do your ratios, bum. You'll be good. Okay? If you start a question and for some reason you see that it is causing you trouble, it will be good for you to stop it as early as possible rather than trying to still, then you are wasting the time. But you have to be careful, because if you do that 2 or 3 times, you will start panicking. So you got to be careful. That's why I said your emotions, your mental state, psychology, and your spiritual state within that 3 hours will determine whether you pass the exam or you fail the exam. Because